Eric Muadid, Muadid.com. Let's take a look at why it's not a good idea sometimes to use ETFs for your analysis. We'll take a look at some charts here and see why a particular ETF is not trading as you might think. Take a look at the Chinese market, and we're going to take a look at this movement here from about mid-June of 2014 all the way to the highs of 2015. Here we see that that was good for a gain of about 160%. That's good. All right. And also let's take a look at this pullback here. So there was a pullback in some time between September and October of 2014. Just take a look at how small this pullback was, because it's going to come in play in a second. Also take note of the fact that we dropped from here all the way to about giving back about 50% of the gain, but we never came back to the lows of 2014, June of 2014. All right. Now take a look at the Dow Jones Shenzhen Index, and again we're going to go from June of 2014 to the highs of 2015. That was good for about a 180% gain on this index, and we can see that September, October of 2014 there was a slight drop here, and also when it pulled back off the highs to here, it never came back to the lows of June 2014. Now let's take a look at this ETF, ASHR, which tracks the Chinese market. Now I think this one is an okay instrument because you can see from the lows of June 2014 to the highs of 2015, we can see that this was a little bit less than the main indices, and we can see this was good for about a 150% gain roughly. And we can see the pullback here was slight between September and October. And also we can see that after making this high, it dropped all the way about 50%, maybe somewhere in that range, but it never came back to the lows of June 2014. All right, now compare this with the FXI. Number one, if you take a look at the movement from June 2014 to the highs of 2015, this was only good for about a 47% gain. So even though you are playing the Chinese market, you really outperformed. You might have been correct in your analysis, but this is what you got out of that. Keep in mind that the Chinese market was up, let's call it between 150 all the way to 180%, depending on which index you are using. All right, so there it really underperformed. Also take a look at the drop between September and October of 2014, excuse me. You can see this was a major drop relative to what the Chinese market itself was doing. And worse is the fact that since the highs of 2015, the stock has come back to drop below the June 14 lows. So not only is it underperforming, when it drops significantly worse than the market, because if you bought the stock here, you are upside down, while the Chinese market is trading somewhere around here. So be careful which ETFs you trade. And I'll note here that for the month, the average trading volume for the FXI is about 400 million. You wonder why anybody would want to own this instrument when it really underperforms and is not one for one giving you the results you get in the Chinese market. Be aware that some of these ETFs are not well structured. Eric Muadid, Muadid.com. Good luck, peace, and blessings. ESSEC.